what you need to know about corporate finance to be an effective project manager, and even a director. My name is Guilherme and I'm a project management expert. I help professionals to become successful project managers. How I do that in practice can vary, can be from training, coaching, consulting, mentoring. So because if your goal is to develop your project management skills, my goal is to support you in this journey. And before I start, don't forget to like and share this video here so we can get to more people and more people can learn the importance of project management there. So the topic I'm going to talk about today, it might seem completely outside of project management, but understanding corporate finance, it's essential. Why? Let me start from there. What's the ultimate goal of any project manager? Is to deliver value. How companies measure value very often in projects with business case. So start if you do not understand your project business case, you're not going to be able to manage it properly to make sure that the company gets the value in the end of that. But on top of that, why corporate finance? Because the organization exists to, of course, to deliver value to society. They have a vision, a goal, but companies they need to be profitable. A company that does not make money, money works for companies like oxygen work for us. We need to have oxygen to breathe, otherwise we die. But we don't live just because of the oxygen. So keep in mind the same way there. So corporate finance is the way to assess how a company is going there financially. So they have key performance indicators. They assess how the company is investing money, if it's being managed in a proper way, in a profitable way there. So keep that in mind. Let me give you an example what happened in one of my projects a few years ago to try to make this land in a better way. Few years ago, I was managing a program there, and as part of the program, I had to build samples for qualification of the product, but I also had to build several samples to a customer there, and those samples they were built in a lab. They were very highly manual at this stage, and to support this program, the lab had to do some investments because we were talking about 500 samples, and with the way they were doing there, to produce one sample would take three samples would take 1 week. So I had a couple of months to deliver 500 samples. You can imagine that if you do 10 samples per week, you're not going to reach that how fast that you need there. So the company had to invest in some types of small tools, some type of software, and some better equipment for test those samples. And I was trying to make these, and I created the overview, I share with the company, I share with the lab manager there, so he saw what was coming. But the lab manager, he was struggling to get approvals for doing that because he could not explain that except, oh, we are not going to support the customer. But he did not have all the details to make this a good overview. So he came to me and say, is it easy for you to create a short business case and you can showcase how this is going to be useful for the company? So I created a business case. Yeah, we need 500 samples to produce. This is more or less this is the margin that we have per sample. This is the amount of months. If we shorten this is how it's going to be profitable, and this is what you need to invest. The investment was not high, but with 500 samples we could pay the investment and so on. And then I create a business case. I present to the lab manager and to the European finance director. Both they were quite happy. They asked a couple of questions. I explained, showed the overview. They were quite happy. And then the lab manager was able to present to the decision maker in the USA, the global engineering director. He saw that the business case. He asked a couple of questions, but he approved it right away. Why I'm telling you this story? Because without the business case, the approval to show the extra resource would be very painful. Companies, what they want to make sense that, okay, the decisions are making, they're helping the company to be more profitable, to be more efficient, and so on. So when you put that in a business case in numbers, that makes quite easy. So that will help if you have a good understanding of finance, also to help you in your project. But there's more. Why corporate finance also? Because let's say you're a project manager, so you might be in a meetings, or if you're a project manager, a director. Sometimes you are meeting where you look key performance indicator for a company and you understand, okay, which company, which direction the company is going. And all those things, they are based on corporate finance there. So keep that in mind. So what I'm going to explain to you today here is one of very used key performance indicator to measure value in your organizations. What's called the return of invested capital. First of all, I guess you might have the question, what's a return of invested capital and what's the difference with a ROIC? That most of people hear that. ROIC is return of investment. And I'm going to talk about return of invested capital. Basically, return of investment, it's a measures the profitability of a project. So if your project, the investment for the project is like 1 million, the company gets, I don't know, 500K back. So you have a profitability, or you have the company gets 1.5 million back. So you have a ROIC of 1.5, or depending how you want to show it, you have going to have a profit of 50% of your investment there. Very simple. So the ROIC focusing a project. So if you don't know the ROIC, also you should as a project manager there. Although you don't see very often the ROIC directly like that in business case. What usually you see in a business case? Net present value, IRR, internal rate of return. You're going to see that a payback period, which in a way it's also a way to show the ROIC. Payback period is how long does it take to the money to get the money back? And you're going to see other KPIs like gross margin, operating margin, so. But that may be a topic for another discussion. Keep that in mind. But it's now good to know for you to know that's something called ROIC, ROI, and that's focused in a specific type of project. The difference with the return of invested capital there is that we measure the capital for the entire company operation. So the company is not only going to look for one project, but they are going to look for the full operation there. And why it's interesting for you for as a project manager to understand that? Well, because what you do in your project, if you are doing your project in a proper way, you are going to influence the ROIC of the entire company. Of course, depending on the size of the project, it can be more or less depending on the number of projects that you are doing there. But everything that you do in a project as a project manager influence the return of invested capital. So let's take a look a bit deeper. What's the return of invested capital? Okay, this is the general formula there, but that also does not help to understand how this connection is directly made with your project. So the return of invested capital, it's basically break down in two parts. That's the sales, EBIT. EBIT stands for earning before interest, taxes, and amortization. And you have what's also divided by your sales. So basically here, depending how you want to keep, you're looking for one of the margins. Can be, so you're looking for a margin here for your project. And the other part is sales divided by the invested capital. What's the sales is pretty straightforward, right? It's whatever the company is selling. If you sell products, you sell 1,000 products by $10, you get $10,000 of sales there. What's the invested capital? Is the money that the shareholders, who are the shareholders? The owner of the company there. Whoever is the owners, the partners of the company, or if it's a public company that's negotiated in the stock market there are people, the shareholders are people buying stocks from this company there. So the company that invests put money to create the company and to keep the company running, plus the invested capital also is the company that usually companies they borrow they lend from a bank, for example. Why they do that? Because sometimes they need extra money, and instead of the partners just keep putting money inside of the company, they can get money from the bank to make sure that they have more investments to make, or they can expand their operations in a faster pace there. That's a way to do that. This is a different type of explanation. I don't want to enter in a lot of details here, but I just want to sure that you understand. EBIT by sales, sales divided by invested capital, you are going to come up with your return of invested capital there. So very important for you to understand. So now you have return of invested capital as the way that the companies, they are going to assess the investments of the entire company, meaning that is the company investing this in the right way, they're getting the right returns there, and so on. How does it, how your project affects this? So let's take a look on a very detailed breakdown. So if you are working into a project to create a product, for example, or to create a service, it can be a construction or whatever type of project that you are working on, they can influence. If you have a business case in your project, very likely they can there influence those things directly there. Of course, if you don't have a business case, also because a company is doing a project to increase customer conscience there as marketing there, you expect that you're going to see the results on sales here. The business case might not be so directly easy to measure. There's different ways you can measure, mainly if you're looking for digital marketing, but that's also a different discussion there. So you have your EBIT. What's your EBIT? It's a reflection of your income statement. And so if you should know it. If you don't know by now, I have also some content explaining that. All companies, they have three main income statements or three main financial statements. This is your income statement, this is your balance sheet, and this is your cash flow statement. The income statement is sales, the cost to produce it, the cost for the company operated, and that's it. So if you are working into a project to create a new product, you are going to create sales for the company. So that's the first step, how you identify it. But also the EBIT reflects the profitability of the product. How the project heavily influenced the profitability of the project. Because during the project execution, basically you're going to define the cost of goods sold of a project. Let's put an example here. A company that assembles and sell bikes. Why bikes? Because I think everybody in the world have seen a bike in their life, so it's easier to understand. So the company buy a lot of different components from different suppliers. They assemble everything to sell the bike. So if you are developing a new project, what you're going to do? If you are developing a new bike, probably the company is going to design a bike there. So there's the cost for the design. And the company also will negotiate with the suppliers based on the design for each component. What's the cost for production there? Of course, those costs can be negotiated in the future depending on how much parts are you selling or not. But after you release a project, the chances are that you are not going to be able to make big movements here in this cost of goods sold here. Of course, if you have a good strategic sourcing team, that you might be able to do it depending on prices of commodities and so on. But usually the variation is not be as big as, for example, are changing something on the design to make it easier to change the material to make this a cheaper one. So keep that in mind. So the profitability of the project has a very high influence. Your project there has a very heavy influence there in the profitability of the project. Again, not saying that's not possible to change later on. Yes, it is possible to change later on, but a good negotiation with suppliers already in the project phase, a good design, an effective design that can reduce the cost there, will make a very big difference. Because later on, after the design is fixed, the company can look on sourcing initiatives like if the number of sales go up very high, you can negotiate better price because of the volumes. If the commodity price go down, the raw material price go down, you can negotiate there. Depending on where you're buying this stuff, depending where your supplier is located and where your company is located, can be different from exchange rate. For example, if you are in Europe, in the Eurozone, and you buy stuff from China, or you buy stuff, I don't know, from Malaysia, from Indonesia, the exchange rate will influence there, or for the Americas itself. The exchange rate, of course, is going to play a role here influencing that. Of course, you're not going to be able to control the commodity price. You're not going to be able to control the exchange rate. But the company is able to control the design. That's why it's so heavy influence there. And the negotiations with the supplier. So this is a key point that you can influence for your project. Of course, if you are looking for the ROIC for the full company, it's not only your project that's going to make the influence, but the fact if you design a good project can make a very big difference in the company profitability. Let me tell an example that I've seen from a company a few years ago. They were entering the automotive market there. So they had a project with a very big OEM and they start to sell it and they start to develop the project. But in this company, because they were just starting their project management department, focusing the business case was never, nobody was taking care of the business case, cost management, this kind of stuff. So they were executing the project. The customer asked for change. They were doing buy stuff, put in production, so on. What they figure out, they did the start of production, mass production there. They start to sell this in high quantities there, and the customer continued to ask for changes. They keep continue to do that, and few years later, what the company figure out, they need to start take a look on the business case because that was not helping the company in a profitable way. So when they start to take a look on the project business case, they saw that I think probably I'm not sure if the number is exactly this one, but they saw their operating margin was very low. What I mean by very low, probably 3, 4, 5%. I don't remember the exact number. That's already a few years ago. But what happened? You can imagine if you have a margin of 5 for this project here, and for all the other products, let's assume that you have a margin of 10 or 20, whatever, 10. More items that you sell at 5%, if you do an average, your average here. So more you sell at 5%, lower your average closer to 5%. So that reduces the entire profitability for the entire company. So if you launch a product with very low margin, what's going to happen? You're going to impact the ROIC for the entire company because if this project is selling a lot. Of course, you have a forecast in the business case. You never know how much the company is going to be able to sell. That's always a forecast. That maybe sometimes there are some agreements with a customer. But that might be that you start to sell something to a customer. The customer is selling a lot. I don't know, for example, the iPhone. When they started the iPhone, there was, of course, they were expecting to gain a lot of market, but I'm not sure if they expect that to be that successful. Those number of sales that they had probably 2 or 3 years later. So you can imagine if your company you design a product to go into the iPhone, and you say I don't know 1 million pieces a year. I'm just putting random numbers here, and I don't know, right? And then suddenly the iPhone is a big hit in the entire world, and they are selling 100 millions a year. If you have a very small margin, then you're screwed. Because then you have an agreement with a big customer there that you cannot just simply go walk away. And you have a low margin, that means that you are going to impact the ROIC from the entire company. So your cost of goods sold, that will be reflected, of course, the raw material cost, your production cost, your packaging cost. The production cost will be the assembly cost plus whatever you need to buy to assemble it. The next part that can be very influenced there, the depreciation. What's going to be the depreciation? If you're working to a product or a project that the company requires capex, so the company will require to invest more capital here. So you're going to see, of course, the depreciation in your income statement. But also you're going to increase here, of course, your capex. If you increase your capex, more investments that you need in a project upfront, lower will be your ROIC. And just for you to keep that in mind. What other things I just mentioned, for example, capex. If you have to invest high in capex for production, PPE means for plant, property and equipment there. So you're going to have this challenge there also. Higher your capex, lower your ROIC. So in your design, sometimes what you're looking for, you are looking to reduce and optimize your capex because then you're helping the profitability for the entire company. And what happens if your development cost, for example, if your project is delayed? So the company is designing something, I don't know, for 1 year, expects 1 million of development cost, and you have a lot of trouble there, and your investment, and you delay the project for 2 years. So instead of spending 1 million, you spend 2 million. And this is just random numbers, but very often, depending on the type of project, you see those things in reality. Well, 2 million is one extra million. Again, you're hitting here the ROIC, the return of investment of a company. If you're doing a good negotiation with a supplier, you are going to influence the accounts payable of a company. If you what's an accounts payable? It's the money that the company owns for a supplier, they need to pay it back. So can you imagine if you have a supplier that delivers something to you and you pay with a 30 days condition, meaning that if the supplier delivers today for you, you're going to pay the supplier in 30 days. But if you negotiate in a condition that you're going to pay the supplier today, the company you're paying the supplier is delivering today, and you play with 60 days. That helps because what's called working capital is basically the money that the company is going to need to invest to survive from the time that they pay the supplier until the time they get the money from the customer. So that's kind of you can look like that. So let's mean that you have more time to pay the supplier, you make like that. So that means that the company needs a bit less money for working capital there. Let's assume that you negotiate a better payment condition with your customer. Instead of the customer paying after 60 days, they are going to pay with 30 days. So you negotiate with your supplier, you negotiate with your customer. So a bit less money required as a working capital there. And what if the inventory? Well, if you are working to a lean initiative where you want to operate with low stock, uh, that means low stock means low inventory, means inventory of raw material, inventory of work in progress, and inventory of finished goods because you can have a more efficient operation, and that can be a lean project or stuff that you can take a look even during your own project. You are going to influence the stock level. If you influence the stock level, you influence the working capital level. So those are very important items to discuss. For example, in the beginning of my career, I remember when I was just promoted as for a project manager position in 2012. Then we had this project review board meetings where all the projects were presenting the results for the directors and managers in the company. And one of the things that they always ask in those meetings was about accounts receivable. And I had no clue what accounts receivable mean. What's an account receivable? If you execute a service, let me make a different analogy. If you work in a company for half a month, in the Netherlands, for example, where I'm living right now, you are paid once a month. But if I work 2 weeks in a company, even though I'm not paid yet, the company owns me this money. The company owns me. They need to. If I leave the company, they need to pay me for those 2 weeks that I work. That's what accounts receivable mean. For example, if a company execute a service there or deliver a product there, although the company have not received the money there, they have what's called an accounts receivable. And why I'm explaining that to you? Because I went to several meetings when they talk about accounts receivable for my project, and I had no clue what they were talking about. I say I executed a project, those are the money, this is my cash flow for the project, but I did not know what they mean by accounts receivable. I did not know how they calculate the accounts receivable because they were comparing my income statement there with my cash flow statement, and of course you see a gap, and usually this gap between the revenue that you have and the money that you get, it's in the accounts receivable. Very important. And again, if you don't want to be left out, for example, in those discussions they were talking about accounts receivable, I didn't have a clue, although they were asking me accounts receivable about my project. If you're a manager, you're going to be in those meetings. They are going to talk about EBITDA. They are going to talk about cost of goods sold. They are going to talk about inventory levels, accounts receivable, accounts payable, why you need to reduce capex. If you understand that all those things here, they play a role to the ROIC calculation here, then you understand exactly how you influence the results of the investment of a company. But what if you do not understand all those things? First, you're going to be left out. And then if you are left out, if you're a project manager, a manager, a director, you're not going to participate in the decision making. And it's essential for you to participate in if you, of course, if you do not participate in the decision making, for sure you're not going to be able to evolve and grow into a company. Because again, companies, they must be profitable. Otherwise, they are not going to exist. What a company wants, they want to make sure that they get a good investment, a good ROIC. They want to make sure that they are investing their money in a proper way and they're getting results for that. Why? Because if they're getting good results for that, that also means that they are going to be profitable. That means that you're selecting the right products into your portfolio. You're prioritizing the right initiatives for your company. Finance is always a result. So you're not going to be able to improve your ROIC just working to the finance part. Okay, there's some finance stuff that you can do it, but that's for the finance director. And my intent here is not make you an accountant, a finance consultant, or anything like that. It's just to make sure that if you are an engineer, if you're a project manager, if you're a businessman, you need to understand those stuff. Mainly if you're working to a corporation, you do not understand that, you're going to be left out. I remember also a few years ago, I was discussing a business case with the finance director here. And I think we were talking about something regarding the depreciation and the capex of the project and how we would how that would affect the cost of the gross margin of the project and how we would do this splitting among different projects. And for this meeting, the other project manager for one other project manager was also invited. But this other project manager, he did not know anything about finance. So in 5 minutes of the meeting, he was simply left out. And it was me and the finance director discussing what we should do, how we should do it, how we look for this, how we look for that, how this is reflect in my project, in his project, and he was like just not knowing what's happened. On the top of being left out, what do you think it happened every time this guy needed something from the company? He needed an extra investment, approval for to buy something big. The finance director understood because he could see that this guy did not know anything about cost management, about business case, and how it would reflect in this project. So everything that he had to do it was scrutinized. A lot of questions because he had this. If this person does not understand it, I need to make sure that whatever I'm approving, it's gold. What happened with me? Because with the time I built this good relationship, he understood that I was on top of my cost management. I was on top of my business case management there. If I had to buy something, say, you need to buy, I don't know, 100,000 euros from this supplier. And he would come and he would ask a couple of questions from me. Of course, he would never approve something blindly. But I say, this is for this component, this is considered like that in the business case. We even have a saving, blah, 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 blah. And then I would explain to him the business case. But very short, like 5 minutes. Then he'll say, okay, I trust what you're doing there. Bing. Click the button, approve it. That was it for me. What for the other guy? He asked, okay, how is it? How does it reflect this in your business case? The other guy did not know it. So he'll say, okay, go and check and come back to me. And then the guy come back and check with a business case. But since he did not understand the business case, he does also cannot explain how does it affect it. So what took me like maybe few minutes, half an hour, maximum 1 hour to get approval, took him 5 days, or in some cases even longer. Because then they are going to scrutinize, then more people get involved, there are more discussions, there are more scenarios to be looked into that. What happened? Well, it was a lot of more work for him just because he did not have the knowledge. So he got a lot of more work into his plate. And you can imagine if you do not understand your business case and you get a lot of questions about the business case, it took him 1 week to figure out something just because I understood the business case. I could do it in half an hour. That's how, of course, how you're going to be more effective with your project, more effective as a project manager there. So understanding those breakdowns, they are key to understand what you're doing there. Of course, for example, R&D if a company has, all companies they have R&D, how you're going to influence? Well, if you have a shorter time to market, if you are more effective with an R&D, you also influence the ROIC in a positive way. Understanding those concepts, it's essential if you want to be a successful project manager, an effective project manager, an effective manager, an effective director, if you want to be a CEO. And what if I say, but I don't want to be any of those things, I just want to open my own company? Guess what? You're going to need to figure out those things in your own company because this is important. These things here helps to drive decision making and prioritization. Why? Because you see, company resources are limited. Let's just say that you invest a lot of money in the wrong products. Well, you're not going to sell it. You are going to have a very bad ROIC in general for the company. And sooner or later, you are going to be struggling for money. So, this is essential knowledge I'm sharing here with you. So, keep that in mind and make sure you understand it. And of course, as usual, if you have questions, you can ask here in the comments. You can click in the link here and can see how other things that I can help you. I have a finance course for project managers where I cover more stuff there if you're interested on that one, or I have other types of training only for project management. But make sure you understand it. That's what I want, the message that I want to share with you here. And again, don't forget to like and share this video here so it can reach more people and more people can understand project management. And also, don't forget to follow me for more content. Every week there's more content, and every week also, and daily there's more content on my Instagram. Thank you and see you soon. Bye.